Afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, December the 29th, and I hope everyone had a wonderful holiday with the family and friends around, and that Santa was good to you, and that you got to enjoy some time off and were able to get rested up as we're heading into, I can't believe we're heading into the new year already with 2023 already upon us. But I wanted to take some time this week to talk about monetary policy over the last decade or so, 12 years, and what it has done to markets and what that means moving forward now that we are back to more normalized or real interest rates, that the Fed has raised the interest rates to those levels. So we have to discuss what the quote-unquote new normal is as we head into 23. So when we look back over the last decade of zero interest rate policy that the Fed introduced to get us out of the Great Recession, it was a wonderful tool to get the economy going. But the problem is when you have zero policies like that and you have loose monetary policy and you have money floating around, it can allow for distortions and it can allow for money to easily flow and go into more speculative assets. And so, for example, one of those, and why you've seen the NASDAQ hit as hard as you've seen it, is you've seen a lot of these growth companies that are speculative growth companies, software as a service, or some type of speculative software or new technology that is entering the market. Well, with zero interest rate policy, when money is cheap to borrow, you can borrow it essentially for nothing, allowing you to fund a lot of growth. Well, what happens is when the cost of that capital goes up, it really limits how much money you can spend on R&D and your growth. And so you need to be a growth provider prior to higher interest rates. And what happened was these companies did pro formas and projections for decades out at 0% interest rates. And this is recent. And so now that you have the cost of capital maybe up 500% for these companies, you're seeing the profitability get very, very much decreased by just having to pay back the debt that they owe, and what you might see moving forward is some of these more speculative names and speculative investments, you may see them go by the wayside or lose a tremendous amount of value, because what investors are looking for now in the new normal, which is really the normal that we've had in many years in the United States economy with higher interest rates and still a very strong economy. But what it does is it allows the speculation to kind of go away and allows us to return to a more disciplined investing environment where it really does matter the products you have, your management team, what type of moat you have, your free cash flow, how you return profits to shareholders, whether it's in buybacks or dividends, that you are profitable and are consistently profitable and can maintain that through tough economic environments or slower economic environments. And those are the things that are going to do well as we move into 23, or as I'd like to say, the return to normal. It is almost refreshing to see that you will have to put forth the effort to pick out the equity names that are going to do well in this environment. And it allows the distortions that have existed in the marketplace to kind of come back in to be more normal and more normal growth rates and run rates. So if you have questions about how to navigate your portfolio as you're heading into 2023 or ways in which we can help you position that, feel free to give us a call. We'd love to talk to you. You can reach us at 346 or 904 346 3460, or as always, check us out online at www.riverplacecapital.com. I hope everybody has a blessed and happy new year and a wonderful 2023 ahead. I'll talk to you next year. Thanks so much.